the statement you made about in every market there's an opportunity. Well, what was the worst market in recent history? The Great Recession in 2008. Just for agents and investors, what happened? Tons of foreclosures. So everybody was hit. Even people that didn't have foreclosures, your values were hit. So you were just kind of like chugging along, making sure you survived this whole mess. But with a lot of foreclosures, that meant banks took back properties.
Yep.
The government took back properties. And what was the opportunity there? BPOs, right? People don't know what a BPO is, but this will like all make sense.
Broker price opinion.
Broker price opinion, meaning they needed to know, well, what is the new price? So agents who were positioned could do that. Now I remember those don't pay very much, but man, you do hundreds of those, thousands of those, it actually pays really good. Secondly is getting all those foreclosed properties as an agent. That's called
REO agent.
REO agent, right? Real estate owned by the mortgage people. And then the government, that the big one was HUD. If you don't know what HUD is, Housing and Urban Development, they took back all the government-backed loans that got foreclosed on. Government doesn't want to own homes, so they give it back. On the investor side, you got super cheap properties, like almost ridiculous. Like what was the price? It went from in the Seattle area, let's think of a suburb, North Seattle suburb area. The house prices could have easily been $300,000 or $400,000 in that prime 2007. At the bottom in 2011, what was that house going for? Like the worst ones.
So the average drop in the market was 41%. But you saw, remember, when something's an average, there's stuff even less than that.
So 50%.
So 50%, sometimes as much as 65.
So like there was...
we sold a house for 60 grand.
So
an actual house.
Yeah, I know. And those are like way out, like Sultan or whatever.
Yeah.
But no, so the point is there was houses anywhere from 100,000, 200,000, 300,000 that now are flirting with $1 million potentially, right? Or $500,000, but still that's like double in value. So all those people that picked that up, not only could they have flipped that, and that's what's ironic about it. The flipping is what kind of caused the mess in 2005, 6, and 7.
Yep, new construction.
But then there were, not just that, I'm saying like people flipping, just buying it, holding onto it for a year and then selling it, right?
Oh, yes.
And then there was the real kind of flipping, and that's what made you the big money. Or if you held it.
I would say it was the speculation is what caused
for
that.
Sure.
That's the word.
Who won in the Great Recession? It was the hustlers.
Yep.
It was the smart investors. It was the ones that actually were putting in some kind of value. With you saying Great Depression kind of signals and this commercial debt being announced by Fed is so intriguing to me because I've been waiting for this for a decade.
And we all have been waiting. And I believe you're going to keep waiting because I think the Fed, it's like the Seahawks and they've been backed into the corner and they're near the end zone. They're just going to punt it on out. And that's what we're going to do.
But there's still opportunity there too.
100%. There's opportunity, but we're going to punt the problem down the field and just deal with it later.
Well, that's why it gets closer to depression. Because it just gets worse and worse and worse as you're punting it. But then the opportunity, if they do punt it, is super low interest rates again. And that is where there is some crazy buy opportunities soon. Like we were talking the next 6 to 12 months.
Let's go through those kind of crazy buy opportunities and think about that out loud. What the Fed talked about here was they talked about commercial debt was more expensive and harder to get. It's harder for small businesses to get money. The cost on HELOCs went up. More people were taking HELOCs. The cost for auto debt went up. Even though it got easier and cheaper to get a residential mortgage, what they actually saw in their data was the low credit borrowers, because the criteria has gotten more stringent, were getting less. This is another example of if you've got money and you've got credit, you're winning right now. And if you don't, technically this market is taking it away from you again.
And is this the time for the opportunity, like at a high level? But if they keep punting it, the opposite side is still opportunity. You just have to know what to do.
I went through, kind of that like, okay, here's all the credit things that are happening. When we flip it over then and just simply look at it from the other side, let's assume the Fed's going to punt, okay? So what does that mean? It means rates will be lower and the economy will still be alive in some form or another by the end of the year. That means if you can get a good multifamily that's small. I'm kind of anti-large multifamily right now because I think of the syndication bubble and the commercial debt bubble is going to cause problems there. But let's say you could go find a 6-unit, a 10-unit, a 4-plex, and I can make it work at today's rate of 7%. What happens The soon as I can get that debt to 5,
It's more valuable. It's easier to work with.
Your cash flow just went up, which of course makes it more valuable and increases your net operating income, which makes it more valuable. So what's interesting is there will be assets over the next 6 months. This applies to single family homes too, just real estate assets in general that you can buy. And as long as they work at the high debt, you instantly will make 15, 20, 30% as debt gets cheaper because you can simply flip it over and you could sell it at that time or just refinance it and get your cash flow up. That's the opportunity, but don't be stupid. Okay, so like we need to be optimistic, but yet cautious. We need to have extra reserves than ordinary. We need to put larger down payments, and we need to prepare for the just in case. That's why the deal has to make sense. So
no speculation.
No speculation.
No room for that speculative kind of like hope for this crazy appreciation or hoping the Fed will do anything guaranteed.
Bingo.
Yeah.
Just to kind of finish this one off and cap this off. The idea here is that 1, the Fed's talking tough to us. 2, they saw credit conditions loosen, and so then they came out and talked tough. 3, we do have a problem with commercial. And so we need to actually probably visit that a little bit more on some of these episodes and dive deeper into it because we got to pay good attention. 4, we know new construction, flipping, land development, because of the lack of supply, is going to be very good as long as I can buy it right. And we know rentals are going to be good because there's not enough supply, which is going to increase rental rates. So it's interesting when you look at this. If the Fed's talking to us about multifamily having a problem, are people pushing out a bunch of multifamily projects in 23 or 24? No. Do banks want to aggressively lend on multifamily? No. Are other investors going, man, I want to go start a multifamily development project? What that then means is in late 25 and in 2026,
there's going to be a super low supply of it, a need for it.
There's going to be a need.
Just like residential.
Which will then do what to rents? You should see a spike. I will bet money on this and we'll put it in the book. 2026 or late 25 rents spike. Why? You can see the hole coming right now.
Which if you're an investor that has that in your portfolio, that's a great thing.
Great.
That's why if you buy smart, kind of plan for both outcomes, what the facts are telling you is there's a higher percentage chance that rents could go up just because supply and demand and just investor psychology, right? Consumer psychology. By the way, this book's going to get real thick because we got a lot of bets going on.